You finally saved $20,000. You're scrolling Zillow. Your friends just bought. Your landlord raised rent again. Every calculator says you can afford a $300,000 house with a $2,000 monthly payment. So you pull the trigger. 6 months later, the water heater dies. $1,500. The property tax bill arrives. It's higher than Zillow estimated. Your homeowner's insurance renewal jumps 40%. Your HOA sends a special assessment for roof repairs. Suddenly, that $2,000 mortgage feels like $2,800. And you're stuck. This is educational content, not personal financial advice. This is the housing trap nobody talks about. Not the mortgage. The phantom payments. The expenses that don't show up in any affordability calculator, but drain $400 to $1,000 more from your account every single month. And if you don't see them coming, they turn homeownership from wealth building into a cage. Here's what's wild. The average American homeowner spends about 1 to 4% of their home's value on maintenance and repairs every year. On a $300,000 house, that's $3,000 to $12,000 annually. That's $250 to $1,000 per month that never appears in your mortgage calculation. Add property taxes. Average is 1.1% of home value annually, so another $2,750 per year, or $230 per month. Homeowners insurance averages $1,400 to $2,000 per year, depending on location. Another $117 to $167 monthly. And if you're in an HOA, tack on another $50 to $500 per month. Do the math. Your $2,000 mortgage just became $2,600 to $3,300 in real monthly cost. That's 30 to 65% more than you budgeted for. Most people miss this because lenders only care about the mortgage payment when they approve you. They'll say you qualify for a $500,000 loan because your income covers the principal and interest. But they don't stress test whether you can handle the water heater dying the same month your property tax escrow runs short. Here's the framework that clarifies everything. I call it the 3 buckets. Every dollar you earn falls into one of 3 places. Bucket 1. Spend. This is survival, rent, food, utilities, minimum debt payments, insurance, transportation. Bucket 2. Save. This is your buffer, emergency fund, down payment fund, anything that protects you from getting wrecked by surprise expenses. Bucket 3. Grow. This is wealth, retirement accounts, index funds, anything compound interest touches. When you rent, your housing cost lives cleanly in bucket 1. You pay your landlord and you're done. Maintenance is their problem. Property taxes are their problem. When the furnace breaks, you text them and wait. Your bucket 1 is predictable. When you own, your housing cost explodes across all 3 buckets. The mortgage is bucket 1. The emergency fund for repairs is bucket 2. And if you bought too much house, bucket 3 starves because you can't afford to contribute to your Roth IRA anymore. Your house poor. Let me show you what house poor actually looks like. Meet subject. Subject earns $70,000 per year. That's about $5,200 monthly after taxes and deductions. Subject gets approved for a $325,000 home with a $2,000 mortgage payment. On paper, that's 38% of take-home income, right at the edge of affordable. But subject forgot the phantom payments. Property taxes in their county run 1.4%. So that's $450 per month in escrow. Homeowners insurance is $2,000 annually because they're near a flood zone, $167 per month. The HOA is $200 per month. And subject needs to budget 1% of home value for annual maintenance. That's $325,000 times 0.01 divided by 12. About $270 per month. Add it up. $2,000 mortgage plus $450 taxes, plus $167 insurance, plus $200 HOA, plus $270 maintenance. Total monthly housing cost, $3,087. That's 59% of subject's take-home pay. The recommended maximum is 30%. Subject just locked themselves into a trap. Now subject can't save, can't build an emergency fund, can't contribute to retirement. One surprise expense, new roof, foundation crack, HVAC replacement, and subject is on a credit card at 22% APR. The house went from asset to anchor. Here's the question nobody asks before buying. Do I have the buffer? Not just the down payment. The buffer. The emergency fund that can handle a $5,000 furnace replacement without touching your retirement account or going into debt. Quick test. If you have less than 6 months of total expenses saved, not just mortgage, but all your phantom payments included, you're not ready to buy. You're one repair away from financial chaos. Let's run a scenario. You're comparing renting at $1,800 per month versus buying a $300,000 house. Standard advice says buying builds equity. Renting is throwing money away. But let's actually compare. Renting, $1,800 per month. That's it. No maintenance. No property tax. No insurance beyond renter's policy at $15 a month. Total cost, $1,815 monthly. And you're free to move, free to invest the difference, free to avoid the phantom payments. Buying that same $300,000 house with 20% down, mortgage at 6.5% is about $1,500 per month. Property taxes, $225. Insurance, $140. Maintenance budget at 1%, $250. Total, $2,115 monthly. $400 more than renting. But wait, you also spent $60,000 on the down payment. If you'd invested that $60,000 in a basic index fund averaging 7% annually, that's $4,200 per year in growth, or $350 per month you're giving up. Add that opportunity. Cost, $2,115 plus $350 equals $2,565 per month true cost of ownership. Renting saves you $750 monthly in this scenario. Over 5 years, that's $45,000 you could invest instead. And you avoided the risk of a housing market downturn, a job loss that forces a distress sale, or a major repair that drains your savings. I'm not saying renting is always better. I'm saying the math depends on your situation. And most people never run the real math. Here's when buying makes sense. When you have 3 things locked in. 1. A fully funded emergency fund. 6 months of expenses, total expenses, including all phantom payments, sitting in a high-yield savings account. 2. Stable income you expect to keep for at least 5 years in the same location. 3. Total monthly housing cost, mortgage plus taxes plus insurance plus HOA plus maintenance, under 30% of your gross income. Ideally, under 25. If you don't have all 3, you're not ready. And that's fine. Renting is not failure. Renting is a strategic choice that keeps you liquid and flexible while you build the buffer. Now let's talk about the maintenance trap specifically, because this is where people get destroyed. You buy the house. Inspector says it's fine. Year 1, nothing major breaks. You think you're golden. Year 2, the roof starts leaking. $4,000. Year 3, the driveway cracks. $3,000 to repave. Year 4, the water heater and HVAC both die within 2 months. $8,000 combined. Year 5, you need new windows because your energy bill is insane. $10,000. Over 5 years, you spent $25,000 on maintenance. That's $5,000 annually or $417 monthly. And you never budgeted for it because year 1 was quiet. This is why the 1 to 4% rule exists. It's not evenly distributed. Some years cost nothing. Some years cost $15,000. You need a separate maintenance fund, bucket 2 money, that sits there waiting for the disaster. Here's the framework. Open a second savings account. Label it House Maintenance Fund. Every month, auto-transfer 1% of your home's value divided by 12. For a $300,000 house, that's $250 per month. Let it build. Don't touch it unless something breaks. If nothing breaks for 2 years, you'll have $6,000 sitting there. When the water heater dies, you pay cash. No credit card. No panic. Most people don't do this. They spend every dollar and hope nothing breaks. Then the furnace dies in January, and they're financing a $4,000 repair at 18% interest because they have no buffer. Let's talk property taxes, because this is the phantom payment that grows. Your mortgage stays fixed if you lock in a rate, but property taxes rise. Local governments reassess home values. Your tax bill climbs. If your home appreciates 20% over 5 years, your property tax bill might climb 20% too. That affordable $200 monthly tax payment becomes $240, then $280. And there's nothing you can do except pay or lose the house. Some states are brutal. New Jersey averages 2.5% effective property tax rate. On a $400,000 home, that's $10,000 annually, over $800 per month. Texas averages 1.8%. Illinois, 1.7%. Compare that to Hawaii at 0.3%. Same home value, wildly different tax burden. If you're buying, research your county's effective property tax rate. Don't trust Zillow's estimate. Call the county assessor. Ask what the actual rate is. Ask if there's a homestead exemption that reduces it. Ask how often they reassess. Then multiply your home's purchase price by that rate and divide by 12. That's your real monthly property tax cost. Homeowner's insurance is the other variable phantom payment. Your lender requires it, but the cost depends on location, home age, claim history, and disaster risk. Coastal areas pay more because of hurricanes. Wildfire zones pay more. Earthquake zones pay more. Older homes with outdated electrical or plumbing pay more. And insurance companies can drop you. If you file 2 claims in 3 years, they might non-renew your policy. Then you're stuck in the high-risk pool, paying triple. I've seen people's insurance jump from $1,200 annually to $4,000 after one hail damage claim. Budget high. If the quote is $1,500 per year, budget $2,000. If it's $2,000, budget $2,500. Insurance only goes up. And if you're in a disaster-prone area, consider whether you're willing to absorb that risk long-term. HOA fees are the phantom payment people ignore because they seem small. $50 a month. No big deal. Except HOAs have the legal power to raise dues and levy special assessments. Your $50 monthly fee can become $100. And if the HOA board decides the community needs a new pool or repaved roads, they can hit you with a $5,000 special assessment due in 90 days. Read the HOA's financials before buying. Ask how much they have in reserves. Ask about planned projects. Ask if there are any pending special assessments. If the HOA has weak reserves or a history of surprise fees, factor that risk into your budget. Here's the decision tree. Start here. Do you have 6 months of expenses saved, including phantom payments? If no, keep renting and build the buffer. If yes, move to the next question. Is your total monthly housing cost under 30% of gross income? If no, you're looking at too much house. Drop your budget or keep renting. If yes, next question. Are you staying in this location for at least 5 years? If no, renting is smarter because transaction costs eat you alive on short timelines. If yes, next question. Can you handle a $10,000 surprise expense without debt? If no, build a bigger buffer. If yes, you might be ready to buy. Most people skip straight to Zillow. They get pre-approved and assume that means they can afford it. But lenders don't care if your house poor. They care if you'll make the payment. You have to run the real numbers yourself. Here's what you do today. Open a spreadsheet. Write down your monthly take-home income after taxes. Then list every fixed expense, current rent or mortgage, utilities, car payment, insurance, phone, subscriptions, groceries, gas, minimum debt payments. Add it up. Subtract from take-home. What's left is your margin. Now calculate what homeownership would actually cost. Take the mortgage payment from any calculator. Add 1.1% of home value, divided by 12 for property taxes. Add your insurance quote, divided by 12. Add HOA if applicable. Add 1% of home value, divided by 12 for maintenance. That's your real monthly housing cost. Compare that number to 30% of your gross monthly income. If it's higher, you can't afford that house. Drop the price range or keep renting. Then check your buffer. Do you have 6 months of total expenses saved? If buying, do you have 6 months of the new higher housing cost saved? Plus the down payment? Plus closing costs? If not, keep building the buffer. Here's your 7-day challenge. Day 1. Calculate your current total monthly expenses, including rent. Day 2. Research property tax rates in your target county. Day 3. Get real homeowners insurance quotes for specific addresses you're considering. Day 4. Add up the phantom payments for a target home. Day 5. Compare total cost to 30% of gross income. Day 6. Check your emergency fund. Do you have 6 months saved? Day 7. Decide, am I ready to buy, or should I keep renting and building the buffer? Most people never do this work. They trust the lender's pre-approval and dive in. Then they're trapped. House poor. Can't save. Can't invest. One repair away from credit card debt. The goal is not to own a house. The goal is financial stability. And sometimes renting is the move that keeps you stable while you build real wealth in bucket 3. Don't let social pressure or FOMO push you into a trap. If you run the numbers and you're not ready, that's fine. Keep renting. Keep investing. Keep building the buffer. When you do buy, you'll do it from a position of strength, not desperation. And you'll have the margin to handle the phantom payments without going broke. Recap. Homeownership costs 30 to 65% more than your mortgage payment because of phantom payments, property taxes, insurance, maintenance, and HOA fees. Use the 3-bucket framework to see where your money actually goes. Don't buy until you have 6 months of total expenses saved, stable income for 5 years, and total housing cost under 30% of gross income. And always budget for maintenance even when nothing is broken, because eventually everything breaks. If this shifted how you see renting versus buying, hit the like button. If you want more breakdowns of money traps people fall into, subscribe. And drop a comment. Are you renting by choice or saving for a down payment? Let's hear where you're at.